Aloha, this is Joshua Hayes for October 8th's market wrap up. And just to start off, it was another down day for the market today, but luckily it wasn't a crash like we've seen three times out of the past 2 weeks. Today, the S&P 500 fell 1.13%. It did have a very negative tail to it. And so it's not showing that it's hammering out a bottom. And another thing is that volume expanded from the day before. So this is definitely a distribution day. The NASDAQ 100, as you can see, closed slightly up at 0.05, but it had a very nasty negative intraday action and opened near its lows, rallied to well into yesterday's down day, but then it fell all the way back to the low to only hold up 63 cents, 0.05%. Volume was also higher, so I would pretty much call this day a negative day. Now looking at the NASDAQ, we'll see the same thing, very similar. We will see that it actually closed down negative 0.83%, but look at volume. Volume was even bigger than on one of the big down days whenever it fell 4.34%, and also it was much bigger than the day when it fell 9.14%. So the last 3 days have seen a lot of volume in the NASDAQ as it's come down, and that kind of makes it look like it's gone a little too far down in a little too short of time. I would call this index extremely oversold, but no, nothing says that a chart that's oversold can't get more oversold, so we can easily still continue to fall. Now taking a look at the Dow Jones Industrial Average, you had another 2% drop today, as it was one of the weakest indexes today on much higher volume than any volume since, what's that date? 9/19. So it's been almost a full month before we've seen volume this high on the Dow Jones Industrial Average. So it's showing that mutual funds and institutional funds and pension funds are now starting to dump these shares no matter at what price they can get. The Russell 2000 fell 2.2%, showing you that small cap stocks are doing even worse as the S&P 600 fell 2.1%. A weekly chart shows exactly how ugly this is. I mean, look at that drop. If you look at 2002, 2003, 2004, 2005, 2006, and 2007, you can't find a single 1 week drop of 17% anywhere else on this chart. Here was its last previous worst week. That's a 10% drop. That's a 9% drop. And the past week, it's dropped 17%, with the Russell 500, 2000, dropping 18%. Just to show you how weak this market is. I mean, that's just extremely a high level of weakness. And with another death cross about ready to show up in the S&P 600, you can be sure that this index is not going to be in a position to buy for quite some time. As you can see, it's hitting the lows not seen since 2005. So I would not be surprised if a 2002 and 2003 lows come into the situation. Now, looking at the New York Stock Exchange, you can see the same nasty picture here with one of its biggest down weeks, as it's down 11% this week during the past 5 sessions. And once again, it sold off today 1.28% on volume, much higher than the day before, showing that institutions are still dumping. Now, with the market hitting new lows, closing at or near the lows of the day, having a weak finish after having an extremely weak finish the day before, you would think the VIX would have rose today, right? Right, but it didn't still close at a new high. The VIX ended up hitting 59.06, which is the new high of day that I believe we've seen since 1987. So even though it shows on this chart that we hit that in 1998, a good friend of mine has told me that this is an old calculation and it never really did hit 60 in 1998. So, and we can see that through this one, the VXO. Let's look at this one really quick. This one, oh, it's down here. Let me just show this one. This one shows a VIX hitting an 83 level intraday, and as you can see in 1998, it only hit a 53 level at its high of day, or a 60 level. And so now we see an 83 level hit, which would be the highest level seen in the stock market since the great crash of 1987. So there's only one difference. Like I said, the volume in 1987 was huge. Let's go look at the Dow Jones Industrial Average. In 1987, up to that point, there was no volume that large. It never saw volume that big before. As you can see here on a single daily chart in October, right here, look at these 2 days. Look at this volume bar, and then look at anything before it. I mean, even if we go on a weekly, 3-day, 4-day, going back to all the way to the 70s, go all the way back to the 1960s and 1961, you can still see in 1987 the volume is much heavier than anything the Dow Jones Industrial Average has ever seen. Now when we compare it to the current crash we're going through, volume's extremely high, no doubt. I mean, we can't deny that. But it's still just, it isn't at the 2006 highest level or the previous level in 2008 whenever it actually had an up day and failed at the 50-day moving average on September 19th. So there's still no capitulation that signals a bottom. And another thing I saw today is that the put-call ratio went from 1.30 yesterday to 1.15 today. So despite the Dow Jones Industrial Average falling 2%, the Russell 2K falling 2.2%, and the S&P 600 falling 2.1%, the crowd actually gained less fear today. And so instead of jumping from 1.3 to 1.4, it fell to 1.15. That, and with a VIX that's not spiking, like on the day that we fell last time, 500 points, it spiked 15%. Today it only moved up 7%. There's no big giant spike showing excessive fear. But the funny thing is to see this up at the levels of when most bottoms have occurred, like in 2002's low, the 2001 bounce, the 1998 rally that led to the 1999 bullish market that led to the 2000 top, the 97 lows from the crisis before it led to the LTCM in 1998. I started trading in 96, so I don't remember what the big deal was in 97 off the top of my head. But and then just looking at the VXO.X, I mean, it's just whatever. I'm going to have to go over here again. You know, it's just like really amazing to see the CBOE OEX volatility index at a level not seen since 1987. So I don't know. I thought that we would have a bounce about 2 days ago whenever we had this bullish candle in the indexes on 10.6. That was blown to bits on 10.7, and then on 10.8 we continue to sell off. So since the nice day where it looked like we could bounce, we're down just 6% alone on the New York Stock Exchange, and on the NASDAQ we're down 6.58%. So there's no bottom here. The only thing I can say is cash is king, and if you don't believe me, look at the United States dollar chart. As soon as it gets over the 50 and 200-day moving average, it makes a 9.65% gain on 50 to 1 margin. What is that, 450% gain in futures? So this just proves it. Now that the white line has golden crossed the purple line, which is the 200-day moving average, the price has found support right at the 50-day moving average, and it continues to move higher. And this chart is much better looking than the world gold. This is what gold looks like right now. Gold looks toppy. So the gold is really not a safe haven right now, even though it is looking okay. The safe haven right now is the United States dollar. Cash is king. We acquired a lot of debt under the George W. Bush administration, but we got the debt pretty cheap. And now that the dollar's higher, they're having to repay us back with higher dollars. So it looks like we've got the good end of that situation. I still would not buy this market. Obviously, as I keep telling everyone that's an amateur, you do not buy stocks that are below the white and purple line. That's the 50 and 200-day moving average. Until these prices are above the 50-day moving average, with the 50-day moving average above the 200-day moving average, and you have a follow-through day, there is no way in Hades that you should be going long stocks in this market. This is Joshua Hayes at BigWaveTrading.com, hoping that I helped you a little bit. Aloha.